But Keki Mistry will be ringing in the opening gong at the Bombay Stock Exchange and ushering in the markets this morning, which look like stable as we speak. 8,009. There you can see him on the screen. 8,009 for the Nifty, 26,469, about 77 points up for the Sensex. It may well start lower, but well, let's see if there are fireworks going ahead. And Nikunj, take it away.
Well, Neeraj, again, a moment in history. The man who runs India's biggest mortgage company will be doing the honors of ringing the gong, Mr. Keki Mistry. It's 9:13, and in next 2 minutes, of course, history will be made once again. And it's important that we showcase a company like HDFC today when market conditions are slightly uncertain, simply because HDFC has been a consistent wealth creator, a consistent outperformer, and foreign institutional investors who may be nervous about the India exposure, they certainly love to own HDFC Limited. So what's the FI holding, sir, in HDFC Limited? 79%. This turmoil is not having impact on that?
No, a little bit impact. The first couple of days there was some impact, but I think markets recovered on Thursday, Friday.
You know, I always tell my friends and some of your shareholders that I think HDFC clearly will be one of the most consistent wealth creators.
Over a long period of time, yes.
Okay. The moment is there. I think it's 9:14 now. So this is, you've been on the board.
Just seconds.
Just give you, you've been on the board, but this must be the first experience for you as well.
First time. So you wait for zero.
You wait for zero. That's 9:15. But you've just come back from a roadshow. What's the mood like?
I came back last week. Last week meaning about 8 days back. So I think the mood is a little nervous about emerging markets, which got reflected in last week's results. But I think India stands out. Clearly India stands out. I think investors also realize that India stands out. Fundamentals are so much better. The foreign exchange position is better. The reduction in oil prices, commodity prices is great news for India. But still, I think it's just a fear of emerging markets, which is
overdone, I guess.
It probably is overdone. Louis.
Okay, there you go. 3, 2, 1. There you go. Right, Neeraj, Aisha, it's back to you guys. Why don't you bring our viewers up to speed with the market opening rates?
Oh yes, a little soft start, but one has to say perhaps Keki Mistry was auspicious for the market. To start off, at least it's not as bad, Nikunj, as what some of the Asian peers were indicating. Maybe now it's trickling in lower, about 0.5% lower for the Sensex and Nifty. So net absolutely in line with what the Asian peers were indicating. That's the mid-cap index in trade for you. Just a little soft, you'd have to say. Just very quickly, the stocks that are going to be in focus this morning. And I just want to start off with the Bank Nifty, because it seems that the RBI governor is hinting at a rate cut. He's saying RBI is not done with the rate cut, still in accommodative mode. That's the word coming in from Raghuram Rajan. Bank Nifty lower by about 0.5% or so. This, of course, becomes sentiment positive. You also have Aurobindo Pharma, which has got the US FDA nod for a generic osteoporosis drug. So watch out for this one as well. A nice 1.7% rally is what you're seeing on Aurobindo Pharma. Good move coming in there. Sun Pharma, Wockhardt, they've recalled drugs from the US market, so perhaps a negative start. About 0.5% lower for Sun, Wockhardt as well, 1.7% lower as we speak. And it seems the government is not going to go ahead with OIL stake soon. That is what some of the ministry officials seem to be indicating. Oil India is holding up by 1.25% as we speak. Ultratech Cement, some capacity expansions coming in there. ONGC is partnering to invest about $24 billion in Mozambique gas field, so watch out for that one as well. And yes, you may want to see what some of the logistics stocks are up to in light of new listings at Bhav Infrastructure, which we'll highlight in just bits from now. Let's see what the others are up to. Snowman, etc. should be holding up well.
Yep, flattish right now, but remember, some of the logistic companies have already had a rally the whole of last week. They were up and about on Thursday session, probably some bit of Friday session as well. Flat in the session today. What's doing well? Some bit of traction for J. Kumar Infra. The volumes are a bit suspect, but it's trading at fresh life highs for itself. Okay, no, it's come off a bit now as well. The rates didn't update, but it's just come off a little bit now, J. Kumar Infra, but did hit fresh highs very, very recently. What else? Gillette is your big mover, 4.5% at 5105. Goes to show if you buy quality, when there is a dip, you typically tend to benefit. Aurobindo Pharma is up 2.5%, and there's some gains coming in for Gujarat Pipavav today. HCL Tech, incidentally, is your top nifty name. But HDFC should be in focus as well. And Nikunj, let's talk to Keki Mistry about all of that and more. Mortgage finance, land bill, economy, and
Rate
whatnot. Rate cuts, yes.
Rate cut. Trust me, every time when you interact with Keki, the first question you want to ask is on rate cut. The governor has set cats among the pigeons, right?
He has. But Nikunj, you look at it in the context of the fact that inflation has really truly come off. Wholesale inflation has been running negative for so long. We are having -4% inflation. Consumer inflation also has come down to very low, very manageable levels. So I guess there is some semblance, some realistic expectation of a rate cut. Now, whether the rate cut comes now or he waits for another 15 days and does it at the time of the credit policy, that's a question of timing.
But there is a case for a out-of-policy rate.
I think there is a reasonable case for an out-of-policy rate cut, given the fact that inflation is so low, given the fact that we need to give a spurt to the economy. So in that sense, there is some case for a rate cut.
But the governor for the longest time has argued that rate cut is important. It is a necessary condition, but not a sufficient condition for economic revival. You need other aspects also to fall into place, and they are not falling into place.
My sense is that the investment cycle is the most critical thing as far as we are concerned. Now, the investment cycle, my sense is that the kind of investments that the government is beginning to make, the kind of contracts that they've started giving, road contracts, rail contracts, I think this will be the spur that the economy requires. And as the government starts spending money around government investment, there will be a lot of private sector investment that will also take place. And then a combination of investment by the public and the private sector taken together will result in a lot of jobs getting created. Jobs will lead to more income, income will lead to more consumption, and as consumption increases, all these good companies with strong balance sheets but excess capacities will start using up those excess capacities and start looking to make investments. So given the demographics in India, given the way we are in India, my sense is that once we start the investment cycle going, once the ball starts rolling, it will just get steam on its own. But the initial thrust is what is important, and which I think the government is now doing.
You just mentioned that you've come back from a roadshow about a week ago, and last 1 week was an extremely volatile week for the world and a challenging week for emerging markets. Do you think in the short term, in the medium term, the outlook for emerging market has got deteriorated and pain is here to stay?
I'm not entirely sure that people have still completely are completely comfortable with emerging markets, or as comfortable as one would have liked to see them. Having said that, India clearly stands out. There is absolutely no question of a doubt about that. India stands out. Our fiscal position is much stronger. Our current account position is a lot better. The rupee relative to other emerging market currencies has been much more stable. Commodity prices coming down, oil prices coming down is all great news for India. So India really stands out. So my sense is that whilst there may be still concerns around China and some of the other emerging markets, markets will, over a period of time, distinguish between India and other emerging markets, because most of the other emerging markets are commodity driven. And if commodity prices are weak, then those economies naturally become weak. But India is not like that. India is an importer of commodities. So when commodity prices are weak, India actually stands out. So this is a time when people, my senses, will realize that India is the best emerging market by far. And therefore my sense is that over a period of time, it may not happen this week, may not happen next week, but over a period of time, India will stand out. The other thing which is worrying people at the moment is this whole thing on will Fed hike, will Fed wait. So that is also a little bit of uncertainty which is there in people's minds.
Mr. Mistry, when markets fell last week, parallels were being drawn. Is it 2011? Is it 2008? What's your sense?
No, my sense is this is something very different. This was a temporary knee-jerk kind of reaction to what happened. See, also we have to recognize that markets had run up a lot. So in the context of a very high market, some correction, some news which would result in some subdued news which would cause markets to come down, I don't think was that unwarranted. The quantum of the fall on Monday was, I think, really truly overdone. But having said that, markets will settle. Give it a little time.
Typically when HDFC Limited stock falls, we wonder that what is going on. It's a stock which foreign institutional investors, they love to own. There are funds who've been owning this stock for 10 years, 15 years, and they've been telling us that 20 years now, and they've been telling us that they would like to own it for another 20 years. HDFC Limited stock fell by about 5-6% on Wednesday. It came back on Thursday. It came back on Friday.
That's right.
But when A quality, when the bluest of the blue chip stocks, they fall, that's always a very negative feeling.
You see, Nikunj, this is more technical than anything else. What happens is when emerging market funds, now there are emerging market funds, there are global funds. Emerging market funds have a large bit of their investment in India. And when emerging market funds start getting redemptions, they have to pay out the money. Now they have to pay out the money, they have to sell liquid stocks. HDFC tends to be a liquid stock. So at that time, HDFC tends to sort of get impacted the most at times like this. But I think these are temporary phenomenon. I think markets will come back. Give it a little while, markets will come back. And you've already seen that on Thursday, Friday, markets did come back a fair bit.
And barring in technical aberration, redemption compulsions, when you speak to some of the key large foreign investors, be it Aberdeen, Wantabell, the capitals of the world, they're still endorsing the HDFC story.
Oh, absolutely.
What were the tough questions which were thrown at you when you went for the
I think it's more questions around the economy, more questions on when the investment cycle will start growing, more than anything specific on HDFC. Because we've been meeting investors now, I've been meeting investors now for more than 20 years. So the questions are more or less sort of settled down. So it's more macro issues, it's more what will happen in India, how will the investment cycle revive, when will it revive, things like that which people are, and interest rates, will interest rates come off? It's more macro questions than specific to HDFC.
The GST has not been rolled out. We don't know whether the 1st of April 2016 deadline would be implemented or not. Government is confident they would be they will be able to implement it, but the ground reality is different. Land bill looks like for the moment is history now. These are two major landmark reforms which the government or the current administration promised, and they may not see light of the day for a long time. That's like saying that one step forward and two steps back.
I mean, look at it in the context of the fact that after this government came in, we increased the insurance. We opened insurance for foreigners. We passed the coal bill. So there are things which the government has done which had not been done for a long time. Now, if you have an agenda which has 20 items and out of 20 items, 10 get done and 10 don't get done, I think that also is a fair fact that these bills which got done by the government were pending for so long and for so many years. So there's some good, some bad. But my sense is still and until they get a sufficient number of seats in the upper house of parliament, they will find it difficult to pass some of these bills unless and until the opposition starts cooperating. And I hope that the opposition does start cooperating because it's good for the country.
Now, for the longest time you've said that, look, you follow a pattern, and the pattern is that the interest rate you charge is a function of your deposit rates. It's cost of funds. Is cost of funds coming down?
Cost of funds has come down, but cost of funds has not come down sufficient enough to make major changes in lending rates. So whatever changes, whatever cost of funds reduction has taken place, we've always passed the benefit back to customers by reducing our lending rates. So if you look at our spreads in March stood at 2.32% and in June spreads stood at 2.31%. So spreads are broadly along same lines. So we had reduced interest rates sometime in June, and the reflection of that interest rates reduction it basically brings back the lending rates in line with where the cost is.
Now, the real estate market is not going anywhere. In some pockets, the real estate prices are coming down, yet you're growing. So what's the secret sauce, sir? You're growing in a market which is not growing.
Nikunj, our growth is coming from middle income customers. Our average loan size for new loans we've given in the current year is 23 lakhs and 40,000 rupees, which typically is middle income customers who are looking to buy a house because they need a house to stay in. They are not investors, they are not speculators, and our customers are not the high-end market. Now, where you see weakness in real estate is largely the big cities, largely the center of big cities, where prices have run up a hell of a lot, and where builders are also building properties which are of extremely large size, and therefore there is limited appetite for people to buy those properties. Also, investors are missing in the market. The high-end market is to some extent dependent on investors, and if investors are out of the high-end market, then clearly there is a reduction in sales, and therefore that gets reflected in property prices perhaps coming down in the cities. But if you look at the outskirts of big cities, if you look at tier 2, tier 3, tier 4 towns, it's business as usual. So if we take our average loan size, even in a city like Mumbai, our average loan size this year would be about 42 lakhs. So if we take a 42 lakh rupee loan and take a 65% loan to value ratio, you're looking at typically a property of 65 to 70 lakhs. Now 70 lakh properties in Mumbai typically means you're looking at the distant outskirts of the city where it's business as usual.
So we've addressed a larger question for the broader audience. Let's address a specific question for your shareholders. You would be unlocking value for HDFC Ltd. First, it would be the insurance arm, and you've said that in the past as well that you are looking at monetizing some of your investments. So which are some of the key investments you would be monetizing now?
See, as of now, it's just the insurance companies. So as far as the life insurance business is concerned, we had said before, and we continue to say that we would like to do an IPO. Once the Standard Life transaction gets completed, which is subject to all the regulatory approvals. Once that gets completed, we would look to file for an IPO. My sense is sometime in 2016, and my sense is the middle of somewhere around the middle or latter part of 2016 is when the IPO would happen. General Insurance, a partner is interested in increasing their stake to a higher level. So that is a discussion which is going on with Ergo and Munich Re. My sense is over the next month or so that discussion will come to some kind of conclusion. So these are the two companies where we would be unlocking some value.
That's the insurance part. What about AMC, other prop investments?
AMC, we have no plans to do anything. AMC, HDFC owns 60%, Standard Life owns 40%. It's a great business. The business does not require capital. We are managing funds in excess of 1,65,000, close to 1,70,000 crores at the end of June. So I think there's no capital requirement. ROEs are high. It's a good margin business. We have no plans to.
And other prop investments?
We have an education finance company. We need to grow that. It's growing very well. It's growing at more than 40% a year. Last year's growth was nearly 41, 42%. But we need to create more steam in that, more base in that, and then at some future date, we will look to see what to do in that.
Now, if I look at the broad numbers, your spreads have been consistent. They've been constant, and irrespective of what's happening in the world, you manage to maintain those spreads. These are volatile times. These are tough times. Things are unpredictable. Are you confident of maintaining your spreads?
We've always talked of a margin. I mean, we talked of a spread range. In a band, in a range. And that range has typically been between 2.2 and 2.35%. And this, if you look back at the last 10, 12 years, you'll see that spreads have never gone below 2.2 and have never gone above 2.35. Given the fact that we have a reasonably well-matched balance sheet, given the fact that we have the ability, if rates go higher, to pass the higher cost to customers, if rates go lower, pass the benefit back to customers, my sense is spreads will remain in that kind of a band.
Let me get some closing comments from you. The home loan market or the HFC market has become extremely competitive. Everybody wants to have a presence there, be it private banks, PSU banks, and even smaller players now, even NBFCs. Can you really maintain such a high digit growth on a large base in a competitive market like this?
See, our strengths come from two facts. I would say our strengths come from three facts. The first fact is our knowledge of property markets. For us, housing is the only product that we offer. So there is complete knowledge across the country, across our branches on the on developers, on markets, on titles, on properties, and so on and so forth. So people come to us not just because they need money. Money is available anywhere. They come to us because they want advice. They want to know whether the property they're buying is good, the builder will complete the project on time, the titles are good, the construction is good, the price they are paying is right, and so on and so forth. We have often stood by customers and helped them through difficult times, and that is word of mouth, that kind of thing spreads. We have sometimes negotiated with customers to get a good deal or negotiated with builders to get a good deal for our customers. So this is the goodwill which we built up over the years. So that's our first strength. Our second strength is the fact that we operate with an extremely low cost structure. Our cost-income ratio last year was 7.6%. Now, for anyone to match a 7.6% cost-income ratio in a retail institution anywhere, forget India, even outside of India, is very, very, very difficult, extremely difficult. And that gives us a decided advantage. And the third is asset quality. So we have always focused on asset quality. We've always told our investors that in the lending business, market share is not relevant. Because you can get all the market share you want by reducing lending rates or by sacrificing lending norms or appraisal norms. But at the end of the day, we want our return on equity to increase every year. We would like growth in a certain manner which we target for ourselves. We aim at asset quality, we aim at operational efficiency, and we aim at customer service. So these are the things which are important to us. So our historical loan losses in all these 35 years is just 4 basis points. These are the 3 big plus points.
So Mistry, I'm glad you could find time for the bell ringing ceremony. And you know, it's really institutions like HDFC which make us feel proud. And you know, world may be volatile, world may be a tough place, but when somebody looks at India, the first port of call always has been HDFC Ltd. And it's only largely because of great managers like you.
Thank you very much. Thank you.
Rajasha, is back to you. And you know, just for the benefit of our viewers, HDFC Ltd is widely owned by foreign institutional investors. It may be a bad Wednesday for HDFC Ltd, but the minute market stabilized, that was the first stock to bounce back. So it's a great company, and I think all of us should feel very proud that it is an Indian company.
You bet. Consistent wealth creator, if you will. That says it all. Nikunj, thanks for getting Keki Mistry's views live from the Bombay Stock Exchange. It's very, very interesting. He's not betting on rate cuts and they're doing well. But the interesting bit, I think, that came out of this conversation for me, aside of course, the asset sales, etc., and all of that, Aisha, is the fact that he's mentioning that real estate prices are coming off where the rates were exorbitantly priced, where the rates have been moderate, which is the market that companies like HDFC or anybody else caters to. Prices that anyways not gone up so much that they'll come back in a hurry, and therefore business might just be stable for housing finance companies. I think that's a very important distinction people need to make.
So basically it's only Mumbai markets.
Yeah, no, but I'm just saying from a stock perspective, it's a great distinction. People would believe that if rates are coming off, why should people buy housing finance companies?
Yeah.
But it's a different game of, you know, a different game out there completely.
Okay.